So OrganiGram, they released a quarter where they screwed up and had that massive recall that a lot of people were talking about, and I wanted to go over it because this is an interesting quarter, primarily because of the screw up, and it's a unique quarter among most companies because this is the first big recall that a company has made, and it's just kind of interesting to take a look at it. Okay, so I have the PDF downloaded over here. We're going to be doing it like that. So they did release it a day or two ago. They released it on their website a little bit later than they give it to a third party. I don't know why. But you can download the financials and the management discussion on their website with the PDF. Annoying thing about the PDF though, you can't highlight anything in it. So I can't highlight the things that I want to talk about, which is why I'm going to be a little bit less organized than I usually would be. So yeah. Alright, so let's get into it. So the first thing that kind of caught my eye when I was looking through this, so on December 7th of 2016, they issued 11.3 million shares, 11.3 million shares at a price of $3.55 per share. So that's a total of $40 million Canadian. So I kind of got a suspicion that that was at the peak because that's a pretty big offering. That's a lot of money. And if you go back and look at the graph, December 7th, yeah, that was pretty much whenever their stock peaked. So their stock was higher for like a few days, for like 4 days, but after that it pretty much dropped. And Emblem did the exact same thing a few weeks ago. So it seems like for these companies, whenever these companies realize that their stock is trading at an unsustainable price or at a price that's pretty inflated, and is a really good value for them to dilute their stock, they tend to dilute it quite heavily. So Emblem did the exact same thing. Their stock for no real reason went up quite a bit. It hit the $2 mark, and as soon as it did that, Emblem diluted the hell out of their stock. And yeah, so if you bought into this company at $1.85, if you're a bank or whoever bought into the offering, but yeah, so that's not good. OrganiGram, the same thing. So it seems like whenever these companies are at their peaks, or whenever these companies have had like massive rallies in the past few months, and whenever they're offering massive stock offerings, might not be the best idea to buy, because the reason why they're offering the stocks is because it's a good price for them. That's why they sold so much. So I just thought that was interesting. Also, one thing really quickly before I move on. I've been waiting to find out the answer to this for quite a while, but it does seem like people overreacted and oversold OrganiGram at a certain point. Now, it did come later than I would have expected it to, but let's go to the 3 months. But around here, so the stock on this day, it dipped to around $1.85. But people did overreact, which is fairly interesting. So this was the time that the lawsuit came out, and then the stock dropped fairly heavily. So yeah, people overreacted, which is interesting because I didn't know whether or not they would. So just something to consider for the future whenever a company screws up big time in this industry, and whenever all the companies did not screw up, people overreacted. So if you bought in during like this nice dip whenever the lawsuit news came out, then you would have had a fairly decent gain. You could have almost doubled your money if you got in at the very low point and then sold in at the very high point. So just something to consider. Anyways, moving on. So whenever OrganiGram is done with their operation, their facility should be producing 26,000 kilograms per year, which is less than other companies, but it's still quite a bit. What else? So the quarterly grams sold is less this quarter for obvious reasons. The recall means that they sold less. They got a lot of returns. They issued a lot of free product, about $2 million worth of free product. That's further down in the report. They're selling oil now, and they're selling a lot more, which is good. If you're holding this company, their revenues are down for obvious reasons. They lost a lot of money, so they lost $5.7 million total, which is pretty significant. 5.3 if you want to adjust, well, excluding adjusted face value, or what does this stand for? Face value? I believe it's face value. But they lost over $5 million, which is fairly significant. Now, something that's kind of interesting is that if you look at the gross margins of OrganiGram over the past few quarters, so they get around 55. They had 55 last quarter. They got 65% gross margins, and these are pretty good. But if you look at Aphria has about 70 or 75%, and Aphria is also improving little by little as they're expanding. So interesting question here. I don't know exactly how far OrganiGram is relative to somebody like Aphria in terms of their expansions and in terms of getting their costs down, but the fact that their gross margins are 50% while Aphria is closer to 75% is fairly interesting, because if they don't find a way to close this, it's not that big of a gap. At 65%, it's not that big of a gap, but there's still a gap. But if they don't find a way to close this gap and catch up to somebody like Aphria, then in the long run, and the long run I do mean at least several years, up until like whenever supply meets demand and prices actually start going down, and competition is actually relevant, up until that point, they should be okay. But after that point, they might start having trouble making money, because if they can't get the same margins as Aphria, then Aphria is going to undercut them and steal their business. So something you want to keep an eye out for, but it's not that relevant over the next year or two, because the supply is still relatively low compared to your demand, so it doesn't matter that much right now. But it's still something that it's very, very relevant. So you want to see this grow over the next few quarters. This quarter doesn't matter because of the recall, but over the next few quarters, you want this number to be growing, or at least staying where it currently is, definitely. And once again, they are expanding, so it's not like it's set in stone. It could grow in the future, but very important that this continues on growing, or at least stays here. So yeah. So we have their losses. Not really going to go into the losses too much. The losses don't really tell you that much. They had a major script. They lost a lot of money. Oh well. They issued 1.5 million incentive stock options to one of their directors, Greg Angel, I think. That's how you pronounce it. And 236 per share. Their price right now is 259 per share. So he is getting a good deal compared to today's price, and he can exercise these within the next few years. And this is pretty common. I don't know if 1.5 million is a lot or if it's a little relative to what he does in his position, but the people that run the company do need to have some sort of a motivation not to drive the company into the ground and actually make the share price grow. So the fact that they're getting shares is a good thing. So yeah. Moving on, I really wish I would have had the highlight feature just so I can highlight the information that I wanted to talk about, but I can't. So it's just more financials, really breaking it down a little bit, not really too relevant. Where's the money that they have invested? So yeah, they spent 2 million. So 2 million in sales returns, which is a lot. Well, not a lot, but significant amount of money. Share-based compensation. So I wanted to talk about this. So currently they have $54 million, or as of February 28th, they had $54 million lying around in, what are these? Investment certificates, and basically they're making a little bit of money off their $54 million, and they can get this $54 million anytime that they want. So they basically have $54 million right now that are collecting interest, and they can pull them out anytime that they want for expansion. So $54 million is pretty good. That should sustain them for quite a while, and they shouldn't have to do any sort of a public stock offering anytime soon. So dilutions, at least for the near-term future, should be minimal, I think, unless they start burning through money like crazy, in which case they might do another one. I don't know. I'm assuming that if the stock price goes up a little bit too much, then they'll just do another dilution, because it will make a lot of sense to them. What else? I think that's pretty much it. Yeah, so 111 million shares out right now. Just more financial information. The financial information for this quarter is not that relevant. They lost some money, and it's done and over with. The more interesting quarters are going to be the next ones, which are the next few quarters will matter a lot, because it will show whether or not this company is continuing and growing, or if it's stagnating, which would be good. Lastly, you have a bunch of risk stuff that is highlighted in the bottom of the management discussion report. If you want to find out more about this company, and if you want to understand the risks associated with this business and some of the things that can possibly go wrong in the future, you might want to read all of this stuff. So there's just a bunch of general copy and paste stuff that is associated with risk, but a lot of it is relevant, like certain regulatory stuff, certain license stuff, it could go wrong. Like license renewal. Where's the product stuff? Consumer perception. So product liability. You know, products can be contaminated with pesticides, and that could result in a recall, which would cause the company's stock to go down. That's one of the risks, and that's something that actually happened to this company. So, if you're going to be investing into this company, read some of this stuff. It might give you a better idea of where the company could go wrong. And I don't know, it's just useful to know. If it does happen in the future, you're at least not going to be surprised with it happening. You'll know that there's a remote possibility of something going wrong. So if you want to, you can read that. But that's about it. That's pretty much all that I really wanted to say. Actually, something that I forgot to mention. So some of you might look at the stock dilutions as a bad thing, the fact that companies dilute their stock whenever at their peaks. So it's kind of a bad thing if you invested into it here for obvious reasons. Like if you bought, where is it? If you bought the stock at around here and then it fell, it's kind of bad for you. But at the same time, if they did some sort of a stock offering and then the stock fell a bunch, you have the opportunity to buy this company for cheap. So you have the opportunity to buy that original $40 million that the company issued at like a 25% discount if you wait a little bit and wait until the stock price falls. So by buying a share of the company, you would be obtaining a share of everything that the company has, and that includes that $40 million that other people paid more for. So in essence, like if you, for example, bought OrganiGram at $2.20, so somewhere around here, you would be getting those shares at a 25% discount if you're looking at that $40 million. If you look at that $40 million that they're currently holding. So in a sense, you're kind of getting value by buying it at a lower price. I don't know if that makes sense. Basically, by buying it at a lower price, you're essentially allowing the company to waste a certain amount of money and still generate value in the future, and you would still benefit off of that. Because if you bought into this company for $3.55 a share, around here, the company would have to basically perfectly utilize those $40 million and make them into more money in order for you to get value, right? So if the company doubles that $40 million, then your shares will have some sort of a value to them. But if the company, let's say, wastes $5 million through their operations, like let's say they expand and in the process they've wasted about $5 million and the other 35 went into expansions, property, and facilities and all of that, well, your shares would be worth a little bit less because $5 million was wasted. But if you bought at around here, it wouldn't be wasted. It would kind of generate you value. So hopefully that makes sense. I don't know how to explain it better. It's just another way of looking at things. It doesn't matter too much, but I'm just trying to get the point across that if a company issued a bunch of stock for $3.55 and you have the opportunity to get it at half of that, then it's actually not a bad deal. If you think that the company has potential in the future, that is. So hopefully this helps. I don't know how helpful this was, but it's something. Hopefully you learned something.